You ever wonder how some people seem to get richer even when the news is all about crashing markets and economic doom? It's a great question, and the answer isn't magic. Nope, it's all about strategy. So let's dive right in and unlock some of the biggest secrets from the world of high finance. And this quote just nails it, doesn't it? While most of us are watching our investments shrink, there's this select group, you could almost call them financial magicians, who are playing a totally different game. And the place where this game is played? It's called a hedge fund. So, what even is a hedge fund? Well, think of it like a super exclusive private investment club. And it's exclusive because it's usually only open to what they call accredited investors, basically very wealthy people and big institutions. This lets these funds operate with way fewer rules than, say, a normal mutual fund, which gives them the freedom to use the kind of complex strategies we're about to get into. And they invest in literally everything: stocks, bonds, currencies, you name it. All right, now for the first big secrets, and this one's a classic hedge fund move. This is how you can make an absolute fortune from a total disaster. It's all about profiting when prices go down. Just think about that for a second. It sounds completely backward, right? Everything we're ever taught is buy low, sell high. So how on earth can you make money when prices are crashing? Well, the answer is a powerful and, let's be honest, often pretty controversial tool called short selling. The core idea is actually simple. You're betting that something, usually a stock, is way overvalued and that its price is about to drop. If you're right, you make money. Okay, so how does this actually work? Let's walk through it. First, your fund borrows a stock that you think is going to tank. Let's say it's trading at $100. Step 2, you immediately sell that borrowed share and you get $100 cash in your pocket. A week goes by and you were right. The stock crashes down to $60. Now you use your cash to buy that share back for just $60. You return the share to the person you borrowed it from, and you just pocketed a $40 profit. But, and this is a huge but, if the stock went up to $150, you'd still have to buy it back to return it, meaning you'd lose $50. Your potential loss is, well, theoretically infinite. And this isn't just some textbook theory. Oh no. This is the exact strategy that allowed some hedge funds to make unbelievable amounts of money during the 2008 financial crisis. They saw the housing bubble, placed massive short bets against it, and, well, you know the rest. Now let's move on to our next secret. So if short selling is like betting on a single piece on the board, our next strategy is like playing a game of chess with the entire global economy. This is what's known as a global macro strategy. What's happening here is a fund manager is looking at the big picture, the macroeconomic trends. They're basically treating the whole world like a giant chessboard, trying to predict the next moves of governments, central banks, and entire economies. So they're asking these huge questions. Will the Japanese yen get weaker against the dollar? Is the European Central Bank about to raise interest rates and slow everything down? They analyze these massive global events, form a theory, and then place enormous bets in the market to cash in if they're right. And here's where it gets really wild. If you want to see just how powerful this can be, look at what happened in 1992. A legendary investor named George Soros basically decided that the British pound was fundamentally flawed. So he placed a bet against it, a bet so massive it directly challenged the entire country's central bank. And the result? He was right. The Bank of England just couldn't hold up, and Soros's fund walked away with over $1 billion in profit in a single day. Just let that sink in. That is the staggering scale we are talking about with a successful global macro trade. Now, of course, these strategies have evolved. While that classic global macro style relies on human analysis, today a new breed of so-called quant funds let computers do the heavy lifting. A fund like Renaissance Technologies, for example, uses these incredibly complex algorithms to crunch millions of data points, making trades in a fraction of a second. Their Medallion fund has reportedly averaged a 66% annual return for decades. I mean, that's a number that no human could ever hope to match consistently. But, and you knew there was a but coming, with these kinds of extraordinary returns comes extraordinary risk. And when these funds get it wrong, the consequences can be absolutely catastrophic. And not just for them. This quote here really captures the flip side perfectly. The potential for these huge profits is almost always built on a mountain of leverage, that is borrowed money. And when that foundation starts to crack, the shockwaves are felt by everyone. Take the case of long-term capital management. This fund was started by absolute superstars, Nobel Prize winners even. They were flying incredibly high. But then Russia defaulted on its debt, an event their super smart models said was basically impossible. This sent a panic through global markets, and in just a few weeks, LTCM had lost billions and was about to completely implode. The situation got so bad that the US Federal Reserve actually had to step in and organize a massive bailout. Why? Because LTCM was so big and so connected to all the major global banks that if it had failed, it could have set off a domino effect that might have taken the entire financial system down with it. So, as we start to wrap this up, there is one really critical thing to remember about all these incredible wins and all these devastating losses. The next time you see a headline about a market crash and hear that somebody made billions, you'll know. You'll know how it probably happened. This wasn't a lucky guess. It was the result of a deliberate, calculated, and incredibly high-stakes strategy. To make these kinds of trades, it takes this really unique combination. You need a precise strategy like short selling or global macro. You need the discipline to stick to it. And frankly, you need a level of financial understanding that is just out of reach for most of us. And all of this leaves us with one final and I think really important question. Knowing that these huge profits and these catastrophic risks aren't just random chance, what does that mean for the stability and the fairness of the global financial system, where these high-stakes games are being played every single day?